seriously, after what happened yesterday, I mean, you got a reprieve. You got the VIX dropping from 50 to 30 overnight. You got the stock market going up from, 1,000 points on the S&P and whatever it was, 2,200 points on the NASDAQ. If you came in this morning and you were not hedged and you knew you had to hedge, there's absolutely no excuse.
Welcome to The Derivative by RCM Alternatives. Send it. Everyone, we got Vineer Bhansali here, LongTail Alpha. It's a Masters opening Thursday. I've been watching the Masters all day. I think that slowed down the volatility a little bit today. Everyone said, enough, let me watch some golf. But it's been a crazy week. So wanted to have you come on and tell us what you're seeing from the front lines. You're just telling us off camera here you haven't slept much. Not because you're nervous, but because there's things to do, right?
Absolutely. So for a person in the long vol tail hedging space, we build positions, obviously, when vol is low, markets are rallying, you have to be counter-cyclical. And you build them patiently with investors who understand that the best time to buy protection is when protection is extremely cheap, which it got to incredibly cheap levels. And I wrote about 3 or 4 pieces in the last 2 weeks saying, basically what's up with vol? Why isn't it going up with what's going on? And then, of course, April 1st, it all kind of started to happen and move, and, vol basically tripled. So, yeah, we build positions when vol is low, markets are up. And then when these events happen, which tend to happen more frequently and with bigger frequency now, we'll talk about that, why we believe things are faster and deeper. And, what we're doing is effectively monetizing because we have a plan in terms of where we're going to take some of the hedges off. So we can either provide the liquidity to our investors or redeploy them into lower strike options or into other asset classes which might not have moved, or going from short-dated options to long-dated options, basically, all the active management levers of option trading. And so we've been up pretty much every night because the index options markets and some of the futures options markets are actually open way, way, way before the official S&P 500 starts trading.
Yeah, you were saying they open at midnight, and that's pretty good liquidity and volume in there.
Yeah, California time, midnight. Yeah, it's not as great as, well, let's talk about liquidity in a minute here. It's not great as the rest of the day, but you can get enough done. You just have to be very careful because obviously there aren't too much of the retail crowd out there and too many of the large market makers participating. But you can do enough, and size attracts size because it's usually professional traders around the world who are involved there. On this topic of liquidity, I guess I can address.
Yeah, we'll dive in.
Yeah, so there's a few metrics, right? And the biggest one at the most superficial level, the highest level, is you look at the depth of the E-mini futures contract stack, the order book, and it's basically evaporated, right? So the easiest way I can say that is there is no liquidity. So if you think you can get anything done in the futures market of any size, you're just fooling yourself because, even now during the all day today and all day yesterday and maybe last week, you could see in the depth monitor maybe about 100 to 150 total contracts. That's the whole stack of all the bids and offers that you can see.
Versus normally
probably 500 to 1,000, maybe 1,500. It can get very deep, especially near closing time and opening time. So you're running at 1/10, maybe even less than that. But yeah, that's a symptom in the equity markets. If you go deeper into the layers, for me, the hierarchy in my brain is the most liquid thing is obviously cash. There's nothing more liquid than cash. Then you have T-bills. Then you move out the duration spectrum to the treasury bond market is a good metric of how liquidity scales with just duration risk. And the 30-year bond, as we all know, has no liquidity right now. It's moving 30, 40 basis points a day. And that then sort of gets absorbed into asset classes that rely on that risk-free asset for discounting, right? So equities, what are equities? Equities are very long
Mm.
cash flow instruments. You have to discount that back on the long bond or 30 or 50 or 100-year bond. So if there's no liquidity in the 30-year treasury, by extension, you can say the thing that you're going to discount those cash flows on, equities, will have very little liquidity. So given that there's so little liquidity in the treasury bond market, I'm actually surprised that there's any liquidity at all in the equity market right now.
Really?
Yeah.
And
So
do you think that is that a function of actual liquidity? Like people, I mean, I guess this is a philosophical question of what is liquidity, but right, is it in my brain, it's because people are scared to death, not normal investor people, just the market makers of like, I'm not putting my neck out there, it's going to get chopped off, right? I can't make it wide enough for it to be profitable for me. If we
exactly.
can rally 200 points in the S&P in a matter of 6 minutes, whatever it was, like where can I put my marks in order for it to be safe as a market maker?
Oh yeah, I mean, not 600, 200, by the way. I mean, sorry, I know you and I come
Yeah,
from
yeah.
200 was big, 800 points, right? The
Oof.
the Nasdaq was up close to about 1,800 points yesterday, right? The Nasdaq futures, 1,800 points, 10%. So yeah, and in a matter of a few seconds from that, tweet that came out, whatever you call
Yeah.
it these days, not the tweet. Yeah, so to your point,
Truth Social.
yeah, the point is that yeah, so over the last few years, the ecosystem has changed, and I've talked about this before. I think even in your last
Yeah.
podcast I came on, and human beings have been replaced with automated trading bots because they never sleep, they never get tired, and they're basically making that bid offer spread continuously. And what happens in these kind of episodes is the algorithms or algorithm makers are very smart. They calculate what they need to clear a certain volume, and they just say, well, we'd rather shut it down and
Yeah.
let somebody else do it than step up and try to make markets when the S&P futures is jumping 5 points between bid and ask. So the market makers, for the most part, the electronic market makers are just out. So
Mm.
what you're seeing here is probably boutique people or maybe humans. So it comes back to COVID or a COVID type of episode where, I call it this mano a mano trading. It's human against human. And humans are extremely risk averse when it comes to providing liquidity, right? If you remember in the old days, when there was a bond futures pit and floor, there were one or two guys like Tommy Baldwin and others
Yeah.
who would be at the bottom of the pit, and the whole pit would basically stop when this guy would show his hand because it stopped with him. He could turn markets around.
Yeah. He'd bid 5,000
He bid
contracts and
5,000, he'd
yeah.
take it, and he would like boom, the market would reverse and go the other way. Doesn't happen anymore because that person does not exist because nobody wants to be a hero.
Yeah.
And electronic market makers are exactly the anti-hero. They basically say, oh, wait a minute, this tsunami is coming. Instead of stepping in front of it and saying, I'm the man, I'm going to actually join the tsunami and, run with it. So I think the ecosystem is very different right
It, sidebar rumor. I've heard Baldwin actually went and tried to do NASDAQ stocks on the screen and lost a fair amount of money
now.
because he couldn't be that guy in the
Yeah.
NASDAQ market, which you'd
Yeah.
think the bond market's bigger, but there was the physical, as you're saying, the physical human nature of it let him
Yeah.
do that.
Exactly.
Uh, but right, like that's a weird thing to me because liquidity to me means, oh, there's not trades on both sides versus the market. I don't know if there's a question in there, but right, it's a little nebulous of what does that mean exactly. Like there's plenty of people wanting to buy and sell, but the market makers aren't there, so that we just can't you can't match them up, I guess.
Yeah. And also, we have to also admit and agree that there's a lot of retail participation. I just spoke with somebody recently who basically has been selling naked zero DTE options, right? So just like literally just selling it and collecting the binary daily payoff is like it goes up through my strike or down through my strike. I'll lose money, but if it doesn't, then I'll collect. So what has happened is because in the ecosystem there's a lot of retail traders who want to trade, but they are not necessarily hedging with futures or with SPY or
Hmm.
anything else. They're just literally running naked positions. You are finding that with these kind of moves, many of these positions are just losing money. So they're losing money. So they're backing off, right? So one of the key structural underpinnings of the markets recently has been the buy the dip mentality because retail comes in and buys it because they can get the liquidity at the end of the day to sell it. Right now, there isn't there. So retail has just stepped back because they're just not there. Maybe margin calls, maybe too much losses. They're not stepping up and providing this buy the dip liquidity because they must have gotten hit pretty badly over the last week or so.
Except for yesterday, right? They thought they'd won. Oh, buy the dip worked again.
Well, it's interesting you say that because I actually had to go and get just a routine physical done. So I went to my doctor's office and my doctor came in and he was clearly, a great guy. I've known him for a long time, but he was a little, impatient. He was like, basically what he said was, I could have bought that dip if I wasn't here to, to give you a physical when the news came out and I could have made a few bucks just by, pushing my phone. So,
Yeah. You should have been like, well, if you're invested with me over here, you wouldn't have to worry about buying the dip.
yeah,
Let's make
exactly.
a
So, but
trade.
anyway, the dip reversed today, right? As we know,
Yeah.
half of it reversed. So we don't know what comes next.
Speaking of the zero DT, have you heard any, right? I think when this first started to become a thing and that volume started to take over, I think what's it been, 60 or 70% or more of the
Yeah,
option volume,
yeah,
right? A few things were one, this is overtaking the VIX. The VIX is not useful anymore because of all this zero DTE was a theory. Two, there's going to be some huge blow up when these types of moves happen. One of the primes or market makers is going to go out of business. So dismiss either of those or both of those. I haven't heard anything of any big firms going under because of zero DTE.
not yet. I mean, I hope
Not
nothing doesn't
yet.
happen.
Yeah.
Yeah, but you never know, right? Somebody's
Yeah.
undercapitalized and overexposed, and maybe preemptively, a lot of firms who might be allowing that kind of speculation are probably not allowing that.
Hmm.
But I don't anecdotally, we don't traffic in those markets.
Yeah.
But again, zero DT is somewhat maligned. I do think there was an economic rationale, during the COVID era and other times, when people kind of had to take out their gambling instincts in the, index options market. But right now, there's very little rationale to speculate on short-dated options. Is because again, coming back to liquidity, there isn't really much you can do unless you're willing to, do a coin flip trade every single day.
Right.
And nobody's
And
gone out of business yet.
most of those are probably most of the retail is selling them, do you believe?
Yeah, I
Yeah.
believe so.
So I
Yeah.
mean, this scenario, maybe they should be buying them.
Yeah. Yeah.
But which leads me to my naively, and I was talking with some guy who does some option stuff. He's like, why don't you just buy the straddle every day? Right? And the market's going to be up or down 5%. I'm like, well, because I think the straddle's priced in for it to move even more than that. So,
Exactly.
right? What have you seen with that? Of like what's working in terms of straddles and strangles, or that's everything's just the price is blown out?
Yeah, so short dated, absolutely correct. So short dated implieds are trading. I mean, you can go look at your screen right now at the money 5,300 S&P puts. You probably get 40 points on a put and a call, 80 points,
Hmm.
right, for a 1 day option. I mean, that's huge, right? So when do you get paid whatever percent and a half or 2% for just a daily option? So it's very tempting that you can get that kind of premium. But to your person's point, you just don't know when you're going to get a 5% move or a 9% move like we had yesterday. So 1% premium earned in a 9% move is a very bad thing to earn.
Yeah.
So realized is realizing 200% and implied is 60% or whatever the number is. So short dated options, in my view, are a coin flip trade, right? So volatility as a metric should not be used for short dated options. And that's the change in the ecosystem.
Full stop or right now?
Well, we don't know, right? So if
Yeah.
right, here it is, right? I mean, I was kind of jokingly talking to somebody yesterday that, you know, I'm a quant by training, and I do financial modeling to figure out what's good and what's bad. And right now on my screen, I just basically put a feed from Truth Social, is because,
Yeah.
any analytical model I can come up with will get overwhelmed with what that signal comes out for good or bad. I don't really know, but really, modeling doesn't make for short dated options any sense. You can come up with your best quantitative model, and like the person you were relaying the information from. So yes, market's moving 5% today, but you could come in tomorrow and move 0%. In
Yeah.
which case, your 5% premium is completely decayed because
Kaput.
yeah, kaput, right? So, but having said all of that, um, if you go longer dated, and I wrote a piece just recently on why longer dated volatility is still quite subdued. It's moved a little bit, but it hasn't moved very much. Credit default swap spreads have moved, but haven't moved very much. And again, credit default swap spreads are like extremely long volatility. And I think the reason really is fundamentally people believe that what has happened over the last few years is going to happen again, where either the Fed's going to ease or we're going to get a pivot from the administration and the markets will just stabilize. So that belief is what I think is holding longer dated volatility still at very low levels. And again, I'm not making a forecast here, but the view is that if what we're seeing today, and this is this whole game theoretic formulation for me right now of what's going on in the world, is multiple people, multiple agents playing multiple games. We don't know what the games are. We don't know what their strategies are. We don't know what their payoffs are. We don't even know what norms they're following. The tails of the distributions are very fat and flat, as people say, right? So you can have movements in the market that actually start taking their own life. So something happens in the market that creates reactions, like maybe what we saw yesterday, that then results in a completely new set of reactions. This path dependency could result in longer volatility for longer, or higher volatility for longer, in which case what we're looking at in the long date space right now might just be too, extremely cheap. So, so anyways,
and define what we're talking about here with short term and long term. Just put some numbers on it. We're talking
3 months and in, I would call short term.
Okay.
And then anything a year or longer, or 9 months and or longer, I'd call long term. And then 3 to 5 years, I call extra long, that you can't really buy, a lot of index options there because that's not a liquid market, but you can do CDS and credit default swaps and things like that. Yeah.
And then on my other point, so when you were saying short term is like a coin flip, you were saying right now, not a year ago or not in normal times, you can model out some short term.
Of course, yes.
Yeah,
In the short term, right, exactly. So in a normal time, if you saw a implied volatility, I mean, again, volatility is not a good measure for long, but assuming you take this simple coin flip binomial model and you translate it to an implied volatility using Black-Scholes, which people do, you'll get an implied volatility of 60%. In the old days, if you got paid 60% implied volatility, i.e. 80 S&P points, or a at the money straddle for 1 day, you would take it all day long. But right now, why isn't everybody selling it? Is because the dangers are that you move 300 points either side before you get to do anything. Yeah.
Right, because no one's willing to buy it. So you've mentioned credit default swaps. Talk a little bit about what else is in your, right, outside of index options, what else is in your toolbox in terms of all these different path dependencies and how you kind of view that side of tail hedging.
Yeah, so we think in terms of
and what
hedging,
it's been doing during all this.
Yeah, absolutely. And when we think about hedging, we think again, kind of given the engineers and quants we are here, in terms of the trade-off between reliability or dependency or how much you can trust is and cost. So the most reliable thing, obviously, to hedge, I mean, other than just selling all your equities and just going into cash, the most reliable thing that you can do is buy a contractual option, like we are just talking about, like index options and so on against your beta in the portfolio. As you become allow for less reliability, you can do cross-market trades, right? So instead of hedging equity options with equity options, you can hedge it with CDX, credit default swaps. We talked about that briefly. Then you start moving in the spectrum and you start thinking about things that respond possibly slower, but if this continues, they should respond. And the thing I'm thinking about there is duration. So you can buy bonds in your portfolio. Now, unfortunately, in the most recent episode, bonds have been dismal for good reasons, because as the equity markets have fallen, people have started romancing, and these tariff issues have escalated. People are romancing basically an escalated tit for tat game in which foreigners who subsidize our treasury bond purchases might not buy them or maybe even sell them. So treasuries and long-term duration has not done very well at all, recently at least. And then you go into strategies like trend following and so on, which people do in various forms, intraday trend all the way to long-term trend. Again, hasn't done very well so far.
No.
I mean, trend following is actually net was down last week and has been down for the year. So in the spectrum, we think we're not, um, you know, attached to just tail hedging. We just think about where is the reliability highest and where is the pricing the highest. So on the spectrum right now, tail hedging is term tail hedging is using options is still the cheapest in my view
Hmm.
because it's the most reliable. But other things will start kicking in as and if this market continues to move in one direction, trend following, duration, and other things. So they're on the radar screen. It's just that we're not overly allocated to them right now because, basically from my calculation, I still believe long dated volatility is actually quite cheap. So short
And
dated
what
options have become expensive in the short run, or maybe fairly priced, one would say, but long dated is still pretty low. Yeah.
and what are your thoughts on the bond duration trade? If that's just a blip, it sounded like you were thinking that still works long term.
Yeah. So the
Was it the
advantage,
basis trade blowing out like all the headlines were saying, or what are your thoughts on what happened yesterday, right? What was that? I've lost track of time. Wednesday night when it
yeah,
was down.
yeah,
Uh,
5 points in the long bond. Yeah, I was there
yeah,
awake in the middle of the night when you were up 25, 30 basis points intra at night at around midnight. Yeah. So then he came back. Okay, so what's going on there, right? So again, having been a professional bond trader for PIMCO and others for such a long time now, that's kind of where I cut my teeth, I guess, in trading. Uh, yeah, so the bond market, I think, has a few things not going for it right now. And the basis trade I'll talk about in a second. That obviously
sure.
is technical. I think it's more of a technicality that requires a little bit more explanation. But at the highest macro level, I think the it's just inflation coming from tariffs, right? The tariffs are a tax, and the market is basically saying in the short run, maybe the value of having a treasury T-bill, call it, or a 2-year treasury, overwhelms the inflation risk because short-run inflation might spike, but at least you're not locking it in for multiple years. But in the long run, if inflation goes up and duration should obviously not do well if inflation goes up because yields will be higher, there's really no reason to justify buying a long bond at 475 or 480 or 5, whatever the number is right now, right? So
Yeah.
so that's number one. That's the macro reason. Number two is that it's extremely illiquid and the bond volatility has gone up a lot. So equity volatility, of course, has spiked to 50, but also what people look at is the move index for rates volatility or swaption volatility and so on. Interest rate volatility is extremely high. So if you think about what the risk in a bond is, the bond's risk is effectively the duration of that bond, 30-year bond is the duration, call it for 28 or 29 years, times interest rate volatility. So if interest rate volatility goes up a lot, like it has recently, the total price risk of a bond is very high. So if you could have justified holding a bond, maybe a year ago with the same duration at a lower volatility, today you cannot because interest rate volatility is about 30% higher. The
Hmm.
move index has moved, I think, like from 100 to 130 or something like that.
And
So
where's
that,
that
yeah,
from a historic level? Is like historic highs above COVID? Where?
I don't think so. I think I think during one of the big European crashes, let me just put it up here. I
Yeah,
think it
sorry,
got
put you on the
to
spot.
200. No, I can put it up here because, yeah, if I remember in 2008, during the financial crisis, it got to 200 basis points annualized. That's the move index. The whole
Yeah.
curve moves differently. And right now, if you think about it, 130. So it's only about a half. But if you look at the long-term charts, it is getting to the point around, actually, I'm sorry, it's exceeded COVID. COVID, my peak shows about only 110. So we're trading above COVID for sure.
Hmm.
So, so think about it from the portfolio construction metrics of somebody who follows like a risk parity portfolio, stocks plus bonds. And by the way, risk parity has done really badly too, because both bonds have gone down and stocks have gone down.
Yeah.
If you're following a risk parity framework and your bond volatility goes up, you have to proportionally de-risk your bond allocation. Because the way risk parity works is you have a total volatility budget.
And add to your stock calc.
Well, exactly. On
Yeah.
margin, you add to the stock, but your total volatility has gone up. So you're basically saying de-risk stocks and de-risk bonds at the
Yeah.
same time. Because risk parity portfolios run with a total vol target, let's say 10% total volatility, and that's allocated proportionately to stocks and bonds and other things based on their own volatility. So stock volatility goes from, call it 20 to 50, or maybe, it's usually disparity looks at historical volatility, 20 to 30 or 20 to 40, you're going to de-risk your stocks. Bond volatility goes from, call it, 100 basis points annualized to 130 annualized. You're going to de-risk it also. So you're de-risking everything. So that leads to this kind of correlated thing. So that's number two. And that kind of is related to, illiquidity in the bond market. Number three is just this fear, and as an existential fear for the market, is that if the Fed doesn't come in and does QE, who is going to fund this massive deficit that we've got, right? I mean, we got whatever, today there was a $20-30 billion 30-year bond issue. It went through okay today, but can we keep doing this if the people who buy our bonds are not going to subsidize, or maybe not provide that funding? So that's number three. And then number four, we can talk about the technicals, the basis trade, which kind of, basis trades blow up frequently, but the one that has blown up this time is the bond versus interest rate swap. If you're interested, I can talk about the
Yeah,
technical.
I'll go back to number three for a second because
Yeah, sure.
this is interesting to me, right? Of like and this is true in the stock market too, of like, have we lost American exceptionalism, right? What's our USPE's 20, the rest of the world's 15. I'm just throwing random numbers out there. Maybe they're 10, but whatever. So if we both lose $1 billion in earnings, our market's going to go down a lot more than the people who are trying to, right? If we try and make it fair, it's going to hurt the US a lot more than the rest of us. But that's a side argument. But if we're, right, is that the argument of like, we're losing American exceptionalism? We don't deserve to have a premium on our bonds, on our stock market, on everything, which is why you're seeing both sides sell off.
Yeah, I think, yeah, that could be true. And I don't really know how it's going to play out in the long run. Maybe, it'll play out just fine. But in the short run, you're exactly right. It's like the dollar has been sold, not bought.
Right.
And the
Which another way of
general,
saying people are losing trust that
correct. That's right.
that we're going to do what we normally do.
Right. And I mean, think about this, right? Gold, we've been, again, reluctantly so, because I'm definitely not a gold bug, but I wrote a
Yeah.
paper 3 years saying, I don't have a choice right now because I've done the analytical exercise. And it all says, and here are the top 10 reasons. I wrote a paper with top 10 reasons why there is an alternative, and I call it GITA. Gold is the alternative. And just like 3 years ago, Gita, right? It's because I don't think there's a choice. So what basically is going on right now for people is, if you de-risk out of the US dollar, what other market can take it? European bond markets can take it, but they've got their own problems. Some money's going to go to European bond markets. Some money's going to go to European equities. And a lot of it's just going to go to precious metals and maybe base metals. So gold's been on a tear. And again, I'm not making a forecast here, but I would not be surprised if we see like another 20 to 30% move in gold up in like a flash, in like a month. And people will say, what happened here? And that's the power of, what you were referring to, is like the secular reallocation of assets from one block to another block. If there's a mass exit out of dollars, it's probably going to end up in other currencies, and then gold in particular.
And then, but was one of the craziest things when gold was down 3% or whatever it was the
Yeah,
other day. So then, right inside of all this are these moves that make sense and then moves that make absolutely zero sense.
yeah,
That was the same day the gold was going down. So that day made me feel like there were mass liquidations,
yes.
right? Of just people, I have to sell everything in my portfolio because I need to meet XYZ margin call. Like, I haven't read much that was actually happening, but that's what that felt like to me when gold was selling off at the same time.
Yeah, and I think you might have read, there was a couple of articles, I think they are believable, that uh, the thinking was that everything would get tariffed, including metals, but then precious metals were excluded. And all the people who did the geographical arbitrage, where they flew in bars of gold on private jets from London uh, to save them from tariffs, right? So they figured out kind of what the approximate tariff rate was, and they said, if gold is trading inside of that value, then we're gonna, put them on a plane, bring him to the U.S., and when the tariffs come in, we can sell it inside of tariffs because they're already inside the U.S.
Mm.
But precious metals
I
and other
missed that
metals,
article. So people were like flying them on
yeah,
Monday in
yeah,
private
yeah,
jets. I got to
absolutely,
go
yeah,
back and look at
yeah.
the flight aware if there was like a huge stream of jets.
There was a great article, I think I could probably dig it up for you, which said there were a lot charter flight, and then the whole trade data was distorted because of the gold that was, it has to be obviously disclosed because you can't
Yeah.
smuggle it in. So
Yeah.
it was disclosed, and that we brought this in, and it actually skewed the trade flow data because of the amount of gold that actually came in
Wow. Right.
inflows.
Like $1 billion
Yeah,
worth of gold.
a few billion. But then people found that these bars were actually not going to get tariffed, or there was no benefit to future gold purchases being, they were not going to get tariffed. So that premium just evaporated, and that resulted in the sell-off. That's kind of one of the stories I heard.
My favorite gold one was Jim Cramer on Monday saying he buys it on his Costco. I guess you can buy gold bars at Costco on his Costco credit card and gets 3% cash back. So he's
Oh,
like, I'm
that's
getting a
incredible.
right. I'm like, I'm sure their gold bars have at least a 3% markup. So you're
Yeah,
probably just
yeah,
about even, but it sounded
exactly.
good.
Yeah.
So three, yeah, who knows what happens there. But so and then four, you were talking about this basis trade. So yeah,
Yeah.
we don't need to go too far in the weeds, but
Yeah.
is it the same, similar to long-term capital management where they're doing on the run versus off the run?
Yeah, it's a little bit different in this case. So this is treasuries versus interest rate swaps, right? So the one of the
Okay.
biggest anomalies that is out there, which is everybody to see and everybody can trade, and people did trade on it, is that the 30-year bond, let's say, is at 495, whatever, to pick a number. A 30-year interest rate swap where you receive fixed, effectively replicate that bond coupon and pay floating rate interest using the SOFR rate. That rate is about call it 4% round numbers, 95 basis points lower. So you scratch your head and you say, why is it that the treasury yield is at, call it 495 and the swap yield is at 4?
Four.
They're effectively the same duration instrument and all that. By the way, the treasury is full faith and credit of the US government. The interest rate swap is basically a contract, fully collateralized, but contract between banks and banks. So what am I going to do? Well, I'm going to buy a bunch of treasuries, and then I am going to, I'm sorry, I'm going to receive a bunch of swaps,
Yeah.
basically buy the swap, earn the swap coupon, and sell the treasury. I'm
Because it's
sorry.
floating, right?
Yeah,
Hedge my rate.
I said backwards the first time. I'm sorry. You might have
Yeah.
edited this out, and my brain didn't get it. I'm going to buy the treasury because I'm getting a 495 yield.
Yeah.
I'm going to pay fixed on the swaps. So my duration is hedged. I said it right the first time there. Okay. I'm receiving a treasury, buying a treasury at 495, and I'm funding it, but I am now paying fixed on the swap at 4%. I'm keeping that 90 basis point spread, and I have no interest rate risk. Sounds like a great trade, doesn't it?
Yeah. Let's
And the
do it.
reason, every year, by the way, it's
Let's
90
lever
basis
it.
points.
Yeah.
But yeah, 90 basis points, you lever it 5 times, you can make 4.5% a year, right? Just from no duration risk. So that's a very classic basis trade, just like the LTCM trade you talked about, or the futures versus cash bond trade that is very
Yeah.
popular. The problem is that when a lot of people do it, and it's levered, something kind of goes awry here, in this case, funding rates or treasury volatility, then some people get tapped out and they have to liquidate. Even though this is a great trade in the long
Mm.
term, you cannot hold it if you're running at 5x and 10x levered, because every 10 basis points is a big mark to market hit, and you might get
Mm.
shut down on it. And how do you buy a treasury? You buy a treasury, but you have to fund it using a repo contract. Anyway, so the bottom line here is that because of the treasury volatility, illiquidity, et cetera, people basically, I think, got forced out
Margin con. Yeah.
margin calls on the treasury side, and then they effectively had to liquidate both edges of it. But for somebody who's got capital who wants to enter it now, it's a better level. I don't know if it's
Yeah.
done, but it's a better level now. So yeah,
Um, but do you think that was enough to make that full Wednesday night move, or that just
no,
once it started building on itself, people
yeah,
just were flooding it?
exactly. And there's no liquidity because if there's a lot of sellers, foreigners are sellers, these basis traders are sellers, and there's very little buyers, and there's two auctions coming, which we had two auctions this week. The question is, do you want to step in front of that train and try to, buy more bonds? And people will say, no, I don't
Mm.
want to. Yeah. So
And what do you think this does for a lot of tail hedging type stuff where like, oh, the index falls too high, I want to go takes which I would call basis, but not
mm,
as we just talked about, but
yeah,
take some basis risk, right? And I'm gonna gold options or bond options or some other cheaper ways to get that sort of tail risk? Do you think that breaks that for a while and people move out of that space?
No, I think you can. I mean, we call them indirect hedges. That's,
Yeah.
one of our I guess tools in the trade, so to speak. When volatility is very cheap, as it was about a month ago or 2 months ago, and VIX
No
was at
reason. Yeah.
15, we were saying, look, don't take basis risk, just be buying straight options. Take no contractual indirect correlation risk, etc. But now that volatility in the short end of the curve, 3 months in, is kind of high, uh, you want to take more basis risk there. You want to
Mm.
do things like put spreads, perhaps. You want to do indirect hedges in other asset classes, right? Because here's one speculative thought that if this thing continues, perhaps the Fed actually gets forced to cut. So one typical indirect hedge that people will start looking at is just SOFR call options. So can you buy call options on the short end of the, used to be the Eurodollar curve, but now it's the SOFR curve. The more far afield you move, like gold calls or currency options or HYG high yield and so on, the more basis risk you're taking. But it becomes a trade-off between how much basis risk you're taking and how what kind of cheapness you're going to get. So it is very attractive, but you kind of have to be able to evaluate the relative value of all of them, which
And hard to know, like in this example, right? Like we should have all bought Swiss franc calls, right? What's been up like 30% in 2 days or something, or not
yeah,
30%, but it's been up huge in 2 days.
right.
Um,
Yeah.
but how do you know which one? That's the risk, right? That's the basis risk. How do we know which of these other items are going to hit?
Yeah, and I think what people typically do there is they run some sort of correlation analysis, right? So they say, what are traditionally the flight to uh, repatriation, flight to quality, right? So if everybody's going to buy gold, where's most of the gold of the world kept? Switzerland. So they're going to have to somehow get into Switzerland. So let's just buy Swiss franc. So Swiss franc is
Mm.
still, quote unquote, a very reliable tail hedge. Because of that reason, it gets a premium, I think, and interest rates are kept very low there. The yen used to be like that in the old days when the yen,
Yeah.
was the reserve currency of sort of savers. People would flock into the yen, and you can see the yen has moved, but it hasn't moved that much. It hasn't moved 30% for sure, and the reason is because Japan's got its own problems, and they're in one of the they've got their own problems, but yeah. So where do you go? So you could go to gold, you could go
Natural
to Swiss franc.
gas.
Not gas, yeah, exactly.
It's so low it can't go any lower.
That's right.
The
Yeah,
Yeah, where do you go? But so if I'm calling you on that Wednesday morning, we're down making new lows. What do I
yeah,
do? Right?
yeah,
It's too late then, or you start to walk through these other items like, okay, well, this is somewhat cheap. This is still somewhat reasonable.
yeah, yeah. And
It,
it comes back. My first question is, what is your pain threshold, right? So it's down. How much are you willing to lose by doing nothing?
hmm,
And at that point, people can kind of calibrate and they'll say, I'm willing to lose nothing at this point. I want protection below 10% or 10, 20%. That means that, they're going to want to hedge it somehow. And then you look at relative value, right? Buying an outright index option for 1 month makes no sense because you're paying a lot of premium. But if you want to go out and lock it in for 6 months or a year, you can do index options. Otherwise, you go into these indirect hedges. And again, the common theme there is, yes, if you take basis risk, it's not as reliable as just buying a cheap pure S&P index option, but having some hedges on is better than not having any hedges on if
hmm.
you're at that point with your portfolio. Yeah.
And then talk through if you could, we're down, whatever. When we're down 20% for the highs,
Yeah.
and I want to put on another 20%, right? Like when does it become in your mind too far away, right? If we're down 60%, do I go down another 20%? Like I get in
Yeah.
theory can always go another 20%, but it seems like there's a practical limit to like I should stop getting way out of the money.
Yeah. So, that's something that we usually, I mean, I know my own kind of utility function, objective function, and so on, and I try to never get into that type of situation, obviously. But if you're already in that situation, you're down 50%, and we know that market sell-off of 80% has happened maybe once or twice, right, in the Great Depression.
Hmm.
You really kind of have to think about it and say, do I really want to hedge down 20 at this point or not? But if an investor says to us, yes, I understand it, that's never happened before, but if it happens, the severity of that outcome will be so huge for
Yeah.
me
I'm out of
and
business,
I'm
basically.
out of business, or I've lost my life savings or whatever it is, then that tells me is that some hedge is still required, even though the premium will be egregious. And at that point, you just have to kind of give them the trade-offs and say, here's the trade-off of doing nothing and versus the trade-off of doing something at this price.
But
Right.
back to current where
Yeah.
we're at now,
Yeah.
right? We're down 20%, and
Yeah.
people are saying even now, like, well, it's too, I missed it, right? I forgot to do, or I didn't do my tail edging. Now it's too late. What would you
Well,
say?
oh, I mean, seriously, after what happened yesterday, I mean, you got a reprieve.
You got another chance. Get
You
in there.
got another chance. So, like, I mean, I'm not just saying this because this is the business I'm in. Is like you got the VIX dropping from 50 to 30 overnight, and you got the stock market going up from 1,000 points on the S&P and whatever it was, 2,200 points in the Nasdaq. If you came in this morning and you were not hedged and you knew you had to hedge, there's absolutely no excuse
Yeah.
uh, for you to not have done something. And that's kind of our mentality right now is that we've only receded back down about half of the sell-off of the last week, and you're still only down 10%, at least in the S&P for the year. So it's barely. I mean, you're sitting in correction territory, not in bear market territory.
Yeah.
And we were
Oh,
in bear market territory yesterday.
yeah,
Yeah,
15 for that's how crazy it's been.
yeah,
Yesterday, bear market. Today, just
yeah,
correction.
yeah.
Over the long term, doing hedging at VIX 40, 50 doesn't make a lot of sense. Would agree?
Well, so again, it comes back to the portfolio, right? So we ran an analysis, just a composite, and I can't give you obviously all the private details,
Yeah,
but
yeah.
we just run a research thing of, one type of portfolio. And we said, if over the last 5 years, and you can go back and look it up, if you had bought S&P 500 and if you had hedged continuously and spent premium through ups and downs, you know, through the debacle of 2022 and all that, where would you have ended up yesterday? And guess what? You ended up, obviously, S&P is higher, so you would have made money on the S&P. What was shocking to me was to find out that if you had done it pro-cyclically, if you had bought hedges when they were somewhat cheap and done less hedging when they were expensive, but still hedge, you actually have made cumulative money, even on the hedges in isolation,
Hmm.
including, and all of that has come literally in 1 week. And so that's a kind of par for the course in this space is that you spend, you spend, you spend, but when the house is burning down, your insurance pays off. So you got to live in the house, i.e. the S&P went up,
Yeah.
and you got to pay for the insurance that paid off, and now you can build a brand new house. I mean, I can't do any better than that. So,
Right.
so if the price of insurance in California, as we know, I'm a California resident here, it's crazy right now, right? Because of the fires and everything, and insurance companies are just jacking up the premiums. We have two choices: not buy insurance and not have home insurance, or live in our house and live in beautiful California and have home insurance. I think most people's choice will be, as long as you can afford it, live in California and buy the home insurance if you can, afford it.
Yeah.
So I think that's basically what it is. So I don't try to time insurance, but I do try to plan it so that at the appropriate time you can renegotiate. Right, that's the beauty of index options and financial market options markets. In a sense, when the price goes up of insurance, if you already have insurance, you can renegotiate the price to a different insurance contract. So
Right.
you can strike it down or whatever you want to do. Yeah.
What sort of things would you want to see, or my brain goes to some big private credit funds blowing up or private equity marking down 30%, things like that. Either what would you see that start to say like, okay, this is picking up steam, this is probably an extended event, versus what would you see on the other side of like, okay, we kind of have the all clear and I'm not as worried about things anymore.
Yeah, so I think we communicated this in some other forum here, but my metric was if the CDS spread, CDX spread, which is the investment grade index, if the spread moved above 75 or so. I mean, initially my number was 65, but now I've
Hmm.
moved it up to 75. If it moves above 75 and stays above 75, then it tells me that the credit markets are coming under stress. And we all know or have read that the way the transmission mechanism works is that when the credit markets come under stress, corporates cannot borrow easily. they start shutting down factories, laying off people. So a crisis turns into a bigger problem, a recession, and so on. And credit spreads went up to about 85 yesterday. Then they retraced to about 68 on the massive rally, and they're back to 75. So we're right on that boundary. So if I don't see them grinding back down again, then I start getting worried that this thing is morphing into something else. But if they nicely grind down and things settle down, I would say it's time to maybe try to dip your toes in and try to, buy risk assets.
And what's the 75? What's that represent?
Oh, okay. Sorry. I should have maybe said that. So that's basically the spread that you would get on this investment grade credit index over like the investment grade, sorry, over the treasury market, basically. So the CDX is an index, a synthetic index of 125 names.
Yeah.
And effectively, if you buy an insurance policy on that basket of corporate credit, investment grade credit, you would today pay approximately 75 basis points of insurance premium against defaults, with some other contractual details.
And in practice, because it's an index, it's hard for that to move substantially, right? How many? 100? What'd you say? 100?
125 names, yeah.
125 names. So even in 08, how many names actually went bankrupt? Probably
very, very few, but exactly to that point in 2008, very few investment grade names went bankrupt. But this spread blew out very, very substantially, right, into the 500 or 600, if I remember correctly.
All
yeah,
right.
And that basically puts a complete kibosh on credit, because if you are paying for short-term treasuries are at 4.5, 10-year notes at, call it, 425 ish, you add a 500 basis point spread on top of it. An investment grade corporate has to pay 10% interest to operate. That is a big negative drag on their balance sheet. So they can't do that. So that's my metric. Actually, as we talk right now, it's 74 bid at 75. So it's right on that cusp.
Yeah.
And we better see it come in if we want things to settle down. If it doesn't, then I think this can continue.
And I guess these feed into each other, right? My brain's like, well, if there's demand destruction because I can't ship my goods to wherever and I have to shut down factories and lay off people anyway.
Yeah.
But that'll be reflected in the CDX.
Correct. It will be absolutely. It will get reflected immediately. And the reason
It's
is
not
very simple.
a credit issue. It's driven by the fundamental issue.
That's right. And people will start pricing in stress and less coverage in the future. And then each individual name that's inside the index, its spread will start widening out, not in the same proportion, obviously, and then the weighted average will start going up because people will just say, hey, I need more protection against lending money, basically, which is what this is to a corporate. Yeah. So there's other metrics people watch also. The yield curve steepening trade. That's a huge signal. The curve has steepened massively, 50 basis points this year. And that basically tells you is again, I think of that as a, straddle on the macroeconomy. Is either inflation picks up long and yields sell off or rise, or we end up into a deflation, depression, recession, whatever it is, and short end yields collapse because the Fed cuts rates. The curve steepener is what the market is looking at an indicator also.
You think if the Fed cutting rates, what does that really do if it's in this tariff situation?
I don't think it does very much at all. You're right.
Yeah.
I think maybe it even raises the long rates more, but I think it's a signal to the market that we have a backstop, and the Fed, as we all know, has something else they can do, which is QE, right? So they can come back and they can just say, okay, corporate bonds, we're just going to start buying them to keep the spreads tight. Treasuries you're worried about? We're going to buy all the treasuries. So,
and what my worry is, we start last Trump term and we did the tariffs and then paid 35 billion or whatever to bail out the farmers.
Yeah.
Because China wasn't bailing, like maybe they'll do 500 billion across all these different industries and companies that everyone comes looking for a handout.
Yeah.
And then what? That's back to COVID. It's maybe inflationary or maybe, I don't know.
Yeah, one of my old partners from PIMCO wrote a piece many years ago. He called it, I still remember it, he called it no exit. And basically, like what you just highlighted is that, is this problem ever going to go away, or is it going to keep recurring because we've used the tool once, we'll use it again in a bigger size? And his point was, once you've done it, you have no end. It's going to keep coming back, because if these tools are out there, they will be used at a higher and higher size. Yeah.
Yeah, and the COVID lesson was, hey, if we ever want to really juice this economy, just give every person in the country
Yep.
$2,000. That'll get things rolling.
Exactly.
Lastly, I said lastly already, but one more. Trend
Sure.
following, getting smashed in the face. Anyone who wants to throw in the towel on trend following, give them some, hey, this we've been here before. This is how it works. Don't panic.
Absolutely. I completely agree. Trend following has a long history, 400 years of working. Three out of
400 years.
Yeah, people have actually very painstakingly collected a lot of data, including rice farmers, I think, I don't know, China or India or something like that. And certainly 100, 150 years that, some very well-recognized people have done research on. But yeah, every 10 years or so, there's 3 to 4 years for trend following that are dismal because there's overcrowding and people are running large positions. They get stopped out, like maybe seeing right now, and then got 3 years of kind of flattish returns and then 3 years of amazing returns. So we are in that cycle, and yeah,
Lumpy.
my views are exactly the same as yours. Is if things continue to move in one direction, trend following will take the hand off from explicit hedging and will start working really well. This is not the time to throw in the towel. This is the time to actually add, in my view, to trend following. Yeah.
And for you as a systematic quant, are these periods like completely frustrating? Like, do you want to pull your hair out, or it looks like you already pulled your hair out. Sorry. But do you
Yeah,
want to
exactly.
pull more of it out?
The-
Right, of like what we're just moving 10% on a tweet? What is happening? I can't model that. Or do you just say
uh,
that's why we have this longer term, right? You've created your own sandbox to play in case this kind of stuff happens.
Yeah, like our firm's motto or the thing that we remind ourselves is basically expect unexpected for resilient portfolio, right? So every single day when I come in, I mean, yes, I'm a quant, but the grain of salt that I use in my model, it's like like a big sand pile. It's like you just have to make sure that you leave a lot of room for error and the kind of things that happened yesterday, which didn't really bother me at all because I
Mm.
am completely expecting those kind of things.
You were at the doctor. You weren't even watching. Yeah.
Yep. No, and so it doesn't bother me. I think it's going to keep happening. I think you just have to go in knowing this will happen, and your primary tool for modeling is not going to be quantitative models. Your primary tool will be literally market feedback mechanisms and response functions and other players and so on.
Yeah.
But that's all part of modeling. That's all part of investing, in my view. So yeah.
Where do you put yesterday on your Mount Rushmore of craziest market days? Does it even make it, or was there crazier stuff in your career?
I think I've seen worse during COVID, maybe 3 or 4 days, definitely during GFC. The Lehman failure, I think some of the younger team members on our team who have not seen a day like this before were asking me what was it like Lehman failure, LTCM failure. Again, all the hair over the last 30 years. I've seen events where I can't believe that this is happening, and now I just come in and I just go,
Yeah, this
another
is
day in the financial markets. Yeah. So yeah. So anyways, yeah.
I love it.
Fortunately, yeah, if you cannot get hurt in days like yesterday, you're doing pretty good. So yeah. Yeah.
All right, Vineer, thanks for copping on. We'll hang in there, keep fighting the fight. We'll talk to you soon.
Great. Thank you. Take care. Appreciate it.
Thank you.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.